Chapter. We're talking real money.
If I push my button, we will be talking real money. But the first thing I always need to do is push the button to turn on the mic. Hello, everyone. Welcome to another really thrilling edition of the Talking Real Money radio show and eventually podcast. I'm Don McDonald, along with short-timer Tom Cock. He's leaving us in just mere moments. All right, mere hours.
I got the wide-brim hat ready. The rhino spray is primed and ready to. Here we go.
You know that people listen to your show when they wish you a good trip to Africa constantly, no matter who you bump into.
Basically, every person I've now seen in the last, or talked to in the last, 2 weeks, thanks to you, has said, hey, have a great time in Africa. And I said, well,
you are welcome.
The most well-publicized international trip since Jackie Kennedy went to Paris or something.
It is my pleasure to help you out.
Thank you. I really appreciate it.
No, you don't. It's nothing. Nothing. Say nothing. Hi, everybody. We're going to talk about money, and we want you to call us at 855-935-TALK, 855-935-8255. Every Saturday, we're here noon to 2 Pacific on Northwest News Radio and, of course, via the Internet all over the planet. 3 to 5 Eastern time would be what that converts to, and we like to take your calls live during that time. And Tom and I are here today taking your calls, and then for the next 3 weeks...
Okay, I feel bad enough already. Let's just make it worse. Let's make it worse.
I'll be doing the show by myself. So if you don't want to call today and want to call like next week or the week after, that'd be fine too.
Cue Eric Carmen, I guess, huh? All by myself.
Ooh.
Don't want to be. No.
Wow.
Right.
You know the fingernails on the chalkbord kind of thing? That just gave me that.
You can see why the other brother got all the talent.
Yeah, your other brother got all. How did that happen? I don't either. Hey, so give us a call, 855-935-TALK. We talk about money, but we primarily talk about investing because that's the area of greatest confusion. Most people are really good at, say spending it. Most of us are reasonably good at earning it. We can kind of save it sometimes, but when it comes to investing it, this is where we goof off and mess up all the time. And there's always a new product out there that is trying to vie for your attention. Well, many years ago, that new product was called an exchange-traded fund. And Tom and I came around to them very slowly. They really had to prove themselves to us before we would say, okay, yes, you can use these. Now we love them. We love them, but there is always a big old but. There's a but.
Caveat. Yeah, the caveat is...
Oh, very big language. Can you spell that?
I probably not, so don't test me. I mean, the caveat is not unlike mutual funds or fill in the blank whatever product. There's always something new. There's always something hot. There's always something exciting. But fascinatingly, the returns of those things, it turns out, may be due to the fact that you are excited about that. You're pumping money into it, and that pumps up the securities that fund holds that makes the returns even greater, that gets more people excited and sends things skyrocketing. It's fascinating.
Yeah, and it's it really is it's pretty much only an ETF problem because of the one downside that we've talked about for a long time of ETFs is the fact that they trade daily. I mean, not daily, intraday. They're trading every minute of every day that the markets are open. And so what that does is as money can move in and out at will, which leads to trading and timing with these things. But that's not a big issue, except when it comes to specific types of funds, actively managed funds or sector funds, very tightly sector-oriented funds, where something gets hot, and now the fund, the ETF, must own all the securities. They must be invested. So that forces them to go out and buy the kinds of securities they have in the portfolio at whatever the price is, and they themselves are bidding against themselves, driving the price up.
They're driving the price of the ETF up. They're driving the price of
the underlying stocks.
Yeah, thinly held smaller securities. And, one of the funds, this is a great article from Jason Zweig, as you know, we have a tremendous amount of respect for. But he writes about an exchange traded fund. He goes, The authors of the study wouldn't tell me which fund they were studying, but it fits pretty well with the fund called ARK.
ARK Innovation.
ARK Innovation.
Yeah.
Yeah. So we'll talk about that. in a minute.
ARK Innovation was, for a while, one of the hottest funds going. And so that, caused a lot of people to buy it, which caused it to go up because people were buying. Anyway, we'll talk about that in a minute. 855-935-TALK.
Tom and Don are talking real money.
In medicine, a second opinion might save your life. With investing, a second opinion might save your future. The trick is getting one without a high-pressure sales pitch. Well, I'm Don McDonald, and if you've been listening to Talking Real Money, you know that our goal is to help everyone create a brighter future by investing and managing money better. That's why, in addition to helping everyone on our show and podcast, we are also committed to making our 100% fiduciary advisors at Appella available to help everyone make the best financial decisions based on science. So if you're being pitched a financial product or a system, make sure you get a second opinion with no cost, no obligation, and no annoying sales pitch by going to TalkingRealMoney.com or call 800-386-3004. That's 800-386-3004 or TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Apparently my volume was a little low. Is it better now?
It is sounding a little better now. Yeah, you're just very
well. I got a new. Tyline lent me a new Via the connection
now it
because
sounds better. Yeah.
because mine died last week.
It died before. You've had
and
two
died
now,
before.
Right?
No, the same one. I sent it in for repairs. It came back and died again.
Okay.
So then I sent it in for repairs again. So they sent me a loaner.
Should we assume it's operator error of some kind or something?
No, actually, it was no.
Okay. All right, just checking.
Gee, I can harass you, remember? Doesn't work the other way. Hi, everybody. 855-935-TALK is our phone number here. We're talking about exchange-traded funds, and one of the bugs, and it's a bug, that Jason Zweig of the Wall Street Journal pointed out recently. The bug is that when, and this only, we'll get to this in a minute. Let's talk about the bug first. Some funds, particularly actively managed funds with smaller portfolios, or sector funds with smaller portfolios, when they get hot, when people get excited about them and start buying them up like crazy, they can become a self-fulfilling prophecy, as it were. When you buy the fund, you actually make the fund do better for a while.
Yeah, I mean, so going back to October 2019, ARK Innovation had 1/4 of its $1.6 billion in assets in nine stocks, right? More than 5% of the total shares of each of them. Then what happened? Well, people pumped money in. They started making money, right? Its assets went from $1.9 billion to $17.7 billion in 2020. So that meant they were running out and buying those little stocks more and more and more. Intelia, for example, that little company went up 271% in 1 year.
And the bulk of that was fueled, because it's a small company stock, that growth was fueled by ARK buying shares to take into account all the new money that was coming in. We're talking about ARK Innovation, symbol ARKK.
You've heard of Kathy Smith, perhaps been big in the news lately.
Kathy Woods.
I don't want to call her Kathy Smith.
I don't
There's something there that I probably shouldn't maybe I will with my analyst. Anyway, ARK Innovation's assets peaked at $25.5 billion in 2021, and now guess where they're at? $6.3 billion. So that's a pretty big decrease. And the average for those little stocks annually since then, the average both of them have averaged declines. One of them's average decline annually of 30.1%. The other, 97% a year since then. Wow.
And here's, we talk about how you measure risk, because when you have a portfolio, even like that one, the odds of you losing everything are relatively low. You could lose a lot. 1 year it lost 68%.
That's a lot.
1 year. But we measure risk or volatility with a number called standard deviation. If something doesn't move at all, just this is the easiest way to understand it without going to a statistics class. If something doesn't move at all, it has a 0 standard deviation. The bigger the number is, the more it fluctuates either up or down, actually up
That's
and down.
important to know.
Yeah,
Yep,
it's
that's
not
right.
just, it's a positive number means it's just bouncing more. Doesn't say which way, it just says bouncing more. The standard deviation for the S&P is in the 17
something.
probably 14, 15.
Like yeah, okay.
The average standard deviation for small cap stocks, just the index, is about 22.
Makes sense. Or riskier. They're going to move around
They're
more.
going to move around more. The standard deviation for ARC Innovation, you
What?
got to guess. I'll just let you guess.
Okay.
I'm going to let you guess.
I will say 73.
Oh, okay. You really went high. That's a 73
throwing
is
it up.
like, wow.
I know,
No,
that's
46, and it's that's the highest standard deviation I've ever seen.
I was throwing that out there because I knew Kathy Smith would get mad. Kathy would. Kidding. And the fund, by the way, has lost an annual average of 28% over the last 3 years. Not good. So, but I mean,
Wait a minute, is that right? Yeah, 28% over
Yeah,
the last 3.
28%.
Oh, 5-year
A year.
return. Did you look at its 5-year though?
no, I didn't look. I didn't take time to look at the
Oh,
5
come
years.
on.
Sorry.
Give them a
Yeah?
break. Their 5-year
Okay.
average annual return was 1% per year.
Wow, that's something. All right.
Hey,
so
wait, it's
what do
better
you
than
do?
Bank of America's savings account.
God, don't get me started. What do you do as an investor? I mean, what do you take away from all this? Well, and I think Jason's correct when he writes, beware of funds that deviate drastically from a broad market index by holding only a few dozen stocks or lots of smaller companies. Yeah, because your concentrated position can
No,
go
that's
down.
a duh, huh? Or
That's
duh.
a duh.
Duh.
That's not a huh. That's a duh. Check whether holdings are capped or limited to a fixed proportion of a market index, between 2 and 5%. Now that is a problem because today I think with the Mag 6 or 7, you still got like 30% of the S&P 500, right? So that wouldn't work.
Well, if you have a really massively diversified portfolio, you're not going to be.
I was getting to that.
Yeah, okay.
He says, watch out for rapid growth, but he also mentions, yes, diversification is a good thing because it offers some degree of protection from being way too concentrated in these positions. So, and everybody, as I said, bid up the price of the fund, bid up the price of these stocks, and then the balloon got popped and all the air and prices rushed out.
And that could happen again with any focused portfolio. And that's why we cannot emphasize enough how important diversification is. What was his number? You shouldn't have more of the portfolio than what percent of the portfolio?
2 to 5%, he said.
Okay. Because bear in mind that even in the Vanguard Total World Stock Index Fund, which is the whole planet, Microsoft makes up 3.7%
There you go.
of that portfolio. Microsoft, Apple, NVIDIA, Amazon, and Alphabet and Meta make up more than
30-something?
1, 2, 5, 6, 7, about 15%.
Okay.
15%.
Well, Apple makes up, at the end of the year, 4% of the global market capitalization.
Yeah, it's interesting because they are only 3.15% of VT, of the Vanguard Total World Index. Microsoft's actually bigger. I don't know why.
If it's, our friend at Tesla with his $50 billion payday, he still makes up, I think, a majority of the ARC Innovation Fund. He's number one for Ron Barron of the Barron Funds, even though the portfolio is
Well, you read
down
why they
quite a
said they
bit
were
this
going to
year.
pay him that, because they're going to get more brilliance from him for that extra money.
And they weren't going to get that before. So if I get that kind of raise, I'll be smarter? Is that what you're saying? I'm always hoping, but still, come on.
Here's my thinking. If Appella just gave me $5.5 million right now a year,
Yeah.
I'd probably be gone after about a year.
Yeah, because you have enough money.
I have enough money. Why do I? No, because I like doing the stupid podcast.
But still.
I do like doing the stupid
Is he
podcast.
okay, but here's a question to you. Is he going to get the money? Because it still has to go through the courts again, right?
Yeah, he'll get the money.
You
He'll
think
get
so?
the money. Yeah, he'll get the money. Oh, he's absolutely going to get the money. Yes, he is still the number one holding in ARC. 11.3% of the ARC portfolio is in Tesla. Number 2, wow, She's going to be in a world of hurt. She's going to be in a world of hurt if crypto
Nvidia
doesn't
then?
work. No, she's going to be in a world of hurt if crypto doesn't work. Coinbase is 10% of the portfolio.
Wow.
Roku is 8%.
Right,
Roku?
You mean the people with the TV wand thing?
Yeah.
Okay,
yeah.
That's weird.
I don't like Roku very much, but that's just me. CRISPR, now that one I get. CRISPR's number 4. You know, CRISPR.
Because you like your salads nicer?
CRISPR's gene editing.
Oh, is that what we're working on next hour?
Right.
It's too late for you and I, isn't it? I don't know.
So anyway, the trick is, and there really is no trick. You do not have to, you see a headline, ETFs are a problem because of this. You don't have to worry about it because you're smart and you're not focusing on one segment of the market or chasing after the hottest things, right? You're not doing that, right? Promise me you're not.
Crossing my fingers.
And if you are, then you need to call us right now at 855-935-TALK. It won't hurt. Just call.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Give us a call, 855-935-8255. It's free, and we talk about your money. We'll talk about the things you do wrong. As a matter of fact, hopefully the CRISPR people are working on a way to alter the genes that make us make bad decisions financially. And that way,
I hadn't heard of that.
I just decided that's what they should do.
Okay.
And then we will then
the show will be off the air. We'll have no podcast.
Yeah, no, we'll fix your genes. It's got to be genetic.
We'll
stupid
talk about
decisions.
that. That's actually a topic because but it's also, I guess that would still be your parents. Your parents told you to do this, and people always think I'm nothing like my parents.
Yeah, you are.
Yeah, sure. Okay.
Check your genes with the CRISPR technology. I bet you'll see that you're pretty close to half one and half the other. It may be 55, 45. Your balance, your portfolio balance may be a little off one way or the other, but the odds are you're pretty close to half one and half the other parent. Pretty much. That's our eternal life, really, when you think about it. You make a kid, and there's a big chunk of you still going. You got questions for us?
Lots.
Since nobody called with one?
Nobody called. Yeah, okay. Yeah. This comes from Ted in Renton. He says, AVGE, which is the Avantis Global Equity Fund, exchange-traded fund, and AVUV are relatively new funds with track record info, thus with short track record. So how would a hypothetical $10,000 investment in each yield if the amount were invested in the current portfolio 10 years? In other words, should you be considering returns on how do you make a determination if a fund is only 3 or 4 years old?
How do you make a determination of what? What the future will be?
No, how it would have performed.
But his question was, how much would it have made?
Yeah.
Basically.
If it had been around for 10 years. He wants to compare them to Schwab and Vanguard exchange-traded funds.
This is a terrible exercise because you're not comparing apples to apples. You're comparing apples to peaches or pears even. They may be as close as pears, but they're different. You're not going to find the Avantis all-equity ETF at Vanguard. They just don't have a fund that's like it. Because they buy the whole market, and they don't deviate from the allocation of the market. In other words, they buy the stocks. They buy more of the stocks. They own more of the stocks that are worth more and less of the stocks that are worth less. That's not the way Avantis works. And dimensional funds. We'll be fair. Yep. It's both. Both do the same thing. Avantis and Dimensional have some strict rules. They are not going out and saying, I'm going to pick this stock and this stock and this stock. They have rules. And the stocks must meet these criteria. And as long as the stocks meet those criteria, they're part of the portfolio. When those stocks fail to meet the criteria, they're out of the portfolio. Or they don't get in the first place. So we're comparing apples to bananas. Maybe. Tangerines? Citrus fruit, a little tartar. But here's the thing. You can look back at history of those asset classes that they tend to own. And, for example, the AVGE fund is going to be overweighted to small in value, right?
Yeah, and I looked up the last 4 years to compare Avantis's small cap value fund, AVUV, versus Vanguard's VBR. And the
I bet Avantis outperformed
by quite a bit.
Yeah.
The average return for those 4 years, 2020 through the end of 2023, for the AVUV, 16.6. For VBR, Vanguard's version, 10.2.
But there's a reason. You see, this is not magic. This isn't saying that one fund is smarter than the other. It's not. Well, although one is. What it's saying is that Avantis, by buying more small companies, by overweighting small and value companies, is taking more risk. That's the simple explanation and the right answer. If you want to make more money, you have to take more risk. They own fewer stocks.
Right. They own more value-oriented, riskier companies, right?
Right.
I would agree. You would expect that I think you mentioned standard deviation not long ago, would be higher on the AVUV than it would be on VBR due to those factors. Absolutely.
But here's an interesting exercise. You can look back, though, at how a portfolio built like that might have worked in the past. And when you look back like 25 years, which is a pretty typical kind of retirement savings, it's about 9% per year is what it has been.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Let me share with you that phone number again in case you forgot it. How could you forget it? It's 855-935-TALK. 855-935-8255 to talk about real money on Talking Real Money. Are you a true-blooded American? Are you? Are you a true, tried and true American investor? Well, ladies and gentlemen, let me tell you, index funds are un-American. Help stamp out index funds. That was from a poster from the late 1970s, early 1980s, created by a company called the Leutold Group, an advocate for actively managed mutual funds. They actually said that index funds were un-American. Well, now about half of all investing in funds is done in index funds.
Where are they on apple pie? Just kind of wonder.
Cherry pie you can't have. That's un-American. Okay. Apple pie.
Okay.
Good there.
I'm just going to put that out there.
Yeah. Once again, Market Watch. You gotta love Market Watch and our buddy Brett Aarons. I disagree with Brett Aarons probably more than anybody who writes for any publication anywhere.
No.
He drives me crazy. The way Chuck Jaffe hates Susie Orman, I really dislike. I don't hate, but I dislike Brett Aarons. He's basically saying that index funds may be a problem for investors.
Yeah, and the reason is an odd one. Well, okay, first of all, just to go back, he says now 53% of money in mutual funds is in index mutual funds, which I think is about right. That's accurate.
And that's up from 4% through 40 years ago.
40 years ago, yeah.
Right.
So it's been dramatic. People have voted with their feet. But then he goes on to say that's risky because what's happened is index funds are ruining the market because the money goes into the index fund. The people running the index fund say, well, you got to own these stocks because they make up this much of the index fund, and that keep pushing the price of those stocks up. So in his mind now, in the S&P 500 fund, $32 of 100 is invested in 6 companies.
Oh, thank you. You hit my biggest problem with this article right on the head when you said S&P 500. Yeah. Once again, this is it's like saying the Dow is not indicative of, if there are only a few stocks in the Dow, so it's being influenced by too much money going into too few stocks. The S&P 500 is not the market, Brett.
No, there's 3,500 publicly traded U.S. stocks. There are many smaller companies, value companies, all kinds of stuff. By the way,
and over 10,000 globally.
Yeah. What did you love the quote that he got from your pals at the Leutold group?
Yeah. By the way, yeah, Brett went to the Leutold group to get their opinion.
To catch up on things.
And
it's
apparently,
been 40 years. Let's
the
see how they're
Leutold
doing.
group continues to believe that index funds are un-American because they said that the high prices bring out the buyers. That the expectations for stock market returns have scarcely been brighter. Well,
yeah, which probably means we're on the we're about ready to head
exactly. We say this all the time. When people are overly excited about the market, that's probably not going to lead to really big returns in the near future. The problem is we're not going to try and predict that because that's a stupid thing to do.
Now, you alluded to something that I think should have been at the beginning of this article, not at the end. The S&P 500 is not the U.S. market. The S&P 500 is not the only place to invest. You should own other things. Like smaller companies. Value companies. And he doesn't even mention international in here, which you should definitely own. All of those things have diversified your portfolio, have reduced the volatility. And over time, by the way, because we just got the big book from Dimensional, the Matrix book.
The Matrix book.
80 years now, 80 years of data. The S&P 500 has earned an annualized return of 11.5%. That's a lot of growth. But had you taken some of that money and put it into smaller companies that are considered value, right? Their price to book ratio. I won't get into all the technical stuff, but had you done that, you would have made not 1, not 2, not 3, 4% more per year, going back 80 years. Don't you think you should have some of those stocks yet? Most people don't. I'm telling you, I look at so many portfolios. You've got to make sure you own some.
And the trick is to make sure you own a little bit of everything, both here and overseas, because markets, while they move similarly, they don't move in lockstep over long periods of time, or at least they haven't.
Tom and Don are talking real money.
Do you suffer from hodgepodgeitis? I'm Don McDonald, and hodgepodgeitis is a disease of your investment portfolio whose symptoms include lots of stocks, loads of random loaded mutual funds, and maybe an annuity or two. Most who suffer from hodgepodgeitis dread opening their quarterly portfolio statements. They feel lost and confused. Investing seems overwhelming and the financial future uncertain. If you believe you suffer from hodgepodgeitis, see a 100% fiduciary investment advisor immediately. A proper diagnosis is the first step to creating a portfolio with a purpose based on a personal plan. Start on the road to recovery now by scheduling a free meeting with an Appella advisor at TalkingRealMoney.com. There is no cost, obligation, or high-pressure sales pitch. Take the first step at TalkingRealMoney.com or call 800-386-3004. Hodgepodgeitis is not a real disease, but treating it has been shown to improve mood, reduce fear, and even lead to a brighter financial future. Results may vary.
Your guides to a really great financial future. Tom and Don are talking real money.
Welcome back to our little program. Our phone number is 855-935-TALK. And, of course, we'd love to have you call us with a question.
Or text us. I get a lot of people.
How do people know your phone number?
They just do. I give it out a lot. I wish I hadn't because I get a lot of calls, but Paul just wrote, thank you, Paul. Math problem. If an Airstream trailer leaves Florida a week ago, and a Toyota RAV4 leaves Seattle sometime in July, what time do they meet in Wisconsin for a barbecue?
July 20th. We did the math. July 20th, they meet for a barbecue.
I'm not driving, however,
we got about a dozen people now signed up for the barbecue.
It's going to be 40. It's
really? You think?
Oh, yeah. Because there's a bunch of people that I'm meeting with the day before that I haven't said I just haven't had time to send them a note, so you got to join us.
Hey, I just found a fact that you're going to find fascinating.
I hope so.
Oh, yeah, you're going to find this fascinating. In May, it was the third lowest number in 10 years for home sales in 1 month. 407,000 nationwide.
I think I heard Clark Howard mention something about this on a recent podcast. Yeah.
All I'm going to say is it's going to be a lot higher in June. The number's going to be higher. No. Oh, that's true. It won't close until July.
My deal won't close till July, and then
Tom is a multi-homeowner now, like me.
Yeah. Oh, yeah.
Like I was when I had a house in Virginia.
Magnet all
He's a
over
magnet.
The place. Yeah.
But it's funny. The home prices are way up. Way up. But this article for Money Magazine says they're way up, but people aren't really happy that they're way up. Sellers aren't happy because they can't sell. Because they're going, yeah, but I've got a 2.5% mortgage. I'm not getting out of that.
No, they don't want to sell. They can sell. They don't want to.
Because then if you sell, you got to go into a house with a 7% mortgage.
I know. I'm not going to have that much left as debt. But yeah, if I was just doing it straight over, I would.
Only because you're in the top 2% of all wealthy people in America.
Stop it. Anyway,
you're higher than me. I'm top 5.
No, I'm never going to live this.
No,
I'm going to start just jettisoning off assets. Just so I go down.
Oh, there you go.
Hand the stuff away.
Well, at least he built me an RV park.
That's true. That'll get used.
Wait, you got 2 houses and an RV park.
I know. One time.
I just thought that was fascinating that housing prices are way up, but the market's just not really happy about it.
It's the lock-in. They're just not doing it. They're not listing the houses.
Yeah. Anyway,
which works well for me because I'm going to be selling. I'm keep it limited for another 5 or 6 weeks.
You're not. Yeah, you'll probably sell that fast in this market.
Oh, I'm hoping that it's a list. I think we're listing on a Wednesday that we open the offers on like Sunday, and then you're picking you and onward. So we'll see.
All right. Your questions invited, 855-935-TALK or at talkingrealmoney.com, which is where this question came from that Tom has right there.
Jeffrey wrote us from Houston. And this is so important, actually. This is a great question. Aren't TDFs, target date funds, basically useless if you have money in other funds? Yeah. In other words, I run into people that have I own this S&P 500 fund, and then I got a target date fund, and then I have this international fund. Well, all those things are in the target date fund.
Right, but you see, that would reverse it then. Do I need other funds if I have a target date fund? No.
But the thing is, for many people that don't want to spend time on any of this, a target date fund is a good solution. Mm-hmm. Right?
It's a good initial solution or simple solution.
Yeah. And you don't have to do anything.
Most target date funds do not do some of the things that we think should be done, which is reducing durations on bonds, overweighting value, overweighting small.
They don't at all do
They
those
don't.
things.
Most. Wait.
I don't think there's any.
Does DFA?
Well, the Avantis has the balance. Yeah. That's not. They use a different word, not balance, but it's not a target date fund formally because it's the same asset allocation.
Oh, that's right. It's always
changing.
The same asset allocation.
Right. Target date fund should generally be adding bonds as you get older, more conservative, right?
Dimensional has target date funds.
Those are target date retirement funds, though. I think they're not target date TDFs. I think they're TDIFs.
Oh.
Anyway.
Whoa.
The point of the matter is you're exactly right, Jeffrey, and this is a problem because a lot of people have tons of redundancy in their portfolio because I have 6 funds in my 401k. I'll own all 6 funds. No. Target date fund takes all those things in. What Don is saying is absolutely correct. If you have a little time and you want to do it right, better than a target date fund, you have a large cap fund, you have a small cap fund, you have international. Hopefully you have REITs. You have short and intermediate term bonds. You do it. You build your own portfolio. It takes more time to do that, and then you got to rebalance. Most people don't want to bother with all that. That's why they do a target date fund. But as I said, I see a lot of people that have target date fund and then the same thing again, owning large cap, et cetera. So
they're building a similar allocation elsewhere. Another place where target date funds make a lot of sense is inside some of the really lousy 401ks and 403bs out there, where they don't have a lot of good choices, and your target date may be your best choice.
See that all the time.
And you don't have to mess with it, which means not having to go back to the salespeople who handle so many of the products.
Touche. So what are we talking about here? We're talking about high expense, actively managed funds, right? Mm-hmm. Non-index funds, right? Again, sort of overlap because oftentimes a 401k plan will have 5 or 6 U.S. large cap growth kind of funds. One might be listed as the S&P 500, but others that are similar. And then maybe one little small cap fund that's actively managed, high expense. And then in that case, you're like, nah, just hold the target date fund because I get it for about a third.
Right. And that's where you go, okay, target date in the 401, 403 for 80% of my money or whatever it is.
Yeah.
And then in other accounts that I have, because I'm a good saver and investor, like the IRA that you have or the Roth that you have or the brokerage account that you have, that's where you go out and you get the good stuff. You get the VBR or you get the Avantis small cap value or you get the DFA small cap value. You get some of those to add that extra kick, which is what we're looking for. Actually, it's a dual-edged sword. Adding small in value adds a little extra kick. It adds a little extra risk to the portfolio, which should, and has in the past, provided a little more return. But it also actually provides a reduced level of volatility.
It's fascinating to believe that when you take a riskier asset, that it reduces the ups and downs. But why would that be? Well, because not everything goes ups and downs together.
They zig when the other's zagging.
Yeah.
Or zag when the other's zigging.
And that's another reason to hold international, right? Because there's another asset class.
And for those of you who are not aware and who diss international investing, I don't think we can repeat this enough because I've had people ask me about it. When was it that international bailed out the market? I'll go, 2000s. Really? Yeah.
Like
you remember
ones before the
2000
yes,
to 2010, that 2001, 2010?
Yeah.
In there, they actually refer to that decade as, for the S&P 500, the lost decade. Because if you owned what most people at the time called the market, if it wasn't the Dow, they were talking about the S&P 500. If you owned that over that 10-year period, you would have lost about 10% or about 1% per year.
Yeah. And conversely, had you held a portfolio that had small value international, you made about 6% a year, I think.
About 7%. It was close to 7%.
I'm gonna give that
so
one
it's
back,
substantially more, but you were taking on what many perceived as additional risk. But by diversifying, you reduced it. It's actually simple when you think about it.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Oh, and actually, I want to say something to Paul, who sent you the text. I'm not leaving
Orlando.
We had to do the trip math from Asheville, North Carolina.
That's right.
The reason is the trailer
Yeah.
lives in Asheville because to put it undercover in Florida is ridiculously expensive and really hard to find. Thank you,
I think you can't do it at your house.
Oh, no, I can't put it at my house. Oh, no. Covenants.
Burn it down in about 40 seconds.
No, I'd get $5,000. I'd get a $5,000 fine for putting it at my house.
It will go to you because aren't you the head of the HOA thing or whatever?
I know, but I don't get to.
Oh, okay.
Yeah, no, they don't. I don't get the money. Florida doesn't even allow HOA boards to get paid.
All right, makes sense.
It is a miserable experience. Oh, I just wanted to mention though, it's coming out of Asheville, but I wanted to share this with you. You know how I'm putting the artwork on the side that's the Talking Real Money road trip art, and then I was looking for somebody to do it for me because I don't want to mess it up. I am not a handy person.
I think we could safely say that for both of us.
Yeah, actually. I don't do work around the house. If I do it badly. So actually,
you're a good cook. So
I do. No, but that's not handyman kind of stuff.
No, that's not.
If it's a plumbing thing, I hire a plumber. If it's electrical, I hire an electrician. When it comes to putting a sign on a shiny silver trailer, I want a professional.
Needs to be straight and stay there.
I found this company in Hendersonville, North Carolina, which is a suburb of Asheville or vice versa. And the guy's business is great. It's such a great name. It's called The Mad Scientist.
Mad Scientist. Perfect.
Scientist.
So he's going to do the sign.
SIGNTIST, The Mad Scientist. I just love that
And what are we
name.
talking about? We're talking about Don going across the country.
On the road
starting at
again.
the end of June.
Just
all the way through. I mean, and all joking aside, it's up on the website, talkingrealmoney.com. You can learn where he's going to be. We mentioned that we're meeting up in Madison for a cookout. That's going to be fun. That's July 20th. By the way, I'm going to go to Portland on September 20th. I decided.
You are?
With folks down there. Yeah. So watch for that.
Driving down? Yeah, you'll be driving down.
No, I'm going to fly. I just drove last time. Yeah, I'll fly this time. I did it last time. So anyway, those are all coming up. Retirement East coming up. It's all up on the website.
Oh, I'm getting ready to add, I think, a destination in North Carolina near Linville Falls, near the town of Linville, North Carolina. Tiny
Can't
town
say is how I know it.
along the Blue Ridge Parkway because I needed a place to do the show on Saturday. Because I can't check into the campground until 3, and the show starts at 3 Eastern.
What day is that?
Saturday, it's the first Saturday I'm on the road. Saturday
So it's
29th. Saturday the 29th of June.
So I will not be available that day.
No, I'll be doing it alone.
In
but I'm talking to a winery. I'm in contact with a winery there. So I think I'll do it at the winery so we can do
and yet that's perfect for you because you're a big complainer. So that'll work out well. You at the winery, that's really good.
Well, because, I don't think they grow a lot of grapes in North Carolina, but they have a lot of people who wine.
What did that ad always say? Grown-worthy dad jokes. I'm sorry. So perfect. So anyway, check out the trip. Check out help from us.
Ask us questions at talkingrealmoney.com.
Please do.
And there was something. You also can go there if you want to meet with somebody. Well, for the next few weeks, other than Tom, if you want to talk with one of our advisors, who's going to hand those people out to talk to people?
No idea. You know what?
You don't care.
I'm just sorry to say it.
Never mind. Don't go to talkingrealmoney.com and click on Meet an Advisor. Do not go to talkingrealmoney.com and click on Meet an Advisor. Do anything but at talkingrealmoney.com.
Information and important disclosure related to performance of any specific index or fund quoted in this podcast. Oh, I think I need a nap.